investing into the top decile,
right?
Right? Or top quartile, but really top decile. Like, are you actually investing in the top decile if you only see 100 out of the 1,000 opportunities that come to market every year? So again, like you have to think about it from like the innovation of being able to see more. It's kind of like first principle
thinking and investing, right? When I did my first fund, I was like, oh, I can do an AI fund. I led the AI category, AWS, but I kind of knew, I put my, financial background, my CFA hat on. I was like, well, what's the right way to construct a startup portfolio? Thinking from first principles, you can't get yourself too far into a niche and then you're not seeing the whole universe, right?
Yeah.
You have to broaden your aperture to make really good investment decisions. I think is the lesson there. Hey everyone, welcome back to the Ignite podcast. Today we're delighted to have Winter Mead on the program. He's the founder and CEO of Coolwater Capital. He's a seasoned venture capital expert. He's an entrepreneur, author. I've even read one of his books, so I'm excited to talk to him. Coolwater Capital has often been described as the Y Combinator for new VCs, emerging VCs. He's redefined how new fund managers launch, grow, and connect with institutional investors. So I'm really excited to talk to him because I haven't cracked that institutional investor cadre yet. Beyond that, he's written 2 essential guides to fundraising. He's also shared that expertise at Stanford. Thank you so much for coming on the program, Winter.
Thanks, Brian. Great to be here. Hey, everyone.
So glad to finally talk. I've heard so much amazing things about Coolwater and you specifically. Would love to, kind of just learn, like, how did you fall into this space? It's not something you kind of, maybe now it is, but 15, 20 years ago wasn't something you went to college for.
I still don't know if people go to college for venture capital. Yeah, I figured out what venture capital was maybe as a concept before college, but not as a kind of truly what it is as an industry until after college. I would say luck kind of, to be honest, is what got me into the industry. So I can give you kind of a background, kind of my story for the audience's sake. I'll try to be quick about it. But yeah, I grew up on the East Coast on a farm, right? Like you don't really talk about venture capital on farms too much. You kind of are the recipient of, I think, the venture capital outcome, which is like if a technology makes it to market and it's, relevant and useful for, a lot of consumers, then eventually like it makes it back to the farm. So I'd say I was more like a recipient of advanced technology when I was kind of growing up on the farm, but, didn't really think much of it. Fast forward, kind of, going to college, going to grad school. Then I started to really, I think, study innovation, kind of what it meant. Like what did, disruption truly mean? How did technology actually get developed? Like how did certain technologies win? Why did some win and some didn't, right? Like that's kind of, I started to study that. And yeah, I wrote my dissertation in grad school on the digitization of kind of media, right? In particular, like the movie industry. And how kind of you went from, kind of basic film, right? Kind of physical film to, digits. And what did that mean for, again, disrupting kind of the whole value chain, right? And so that was kind of where it started, I think, from like a studying perspective. When I graduated grad school, I wanted to work kind of, influencing that kind of area where I was studying. So I moved to, San Francisco at the behest of a professor who said, like, you want to do tech, this is where to do it, even if you're studying media, which, traditionally you think LA or New York, like, if you want to do tech, kind of move to San Francisco. Other people had figured that out like 50 years before me, but, it helps to have some good mentors when you're in your formative years. So, took his advice, moved to the Bay Area, kind of worked in startups, got perspective to, what it meant, I think, from the startup perspective, as well as from like the financier perspective, like who are these wealthy people, giving kind of free money to, or what I thought was free money to, these really cool technologists. Fast forward a couple years later, went over to a multifamily office, which is, it's basically a wealth manager or an investment firm set up for family offices, which if, you're listening and you don't know what a family office is, think of it as like someone starts a restaurant chain. The founder of that becomes very wealthy and very successful, so successful that they don't know where to, they can't manage their own wealth and can't invest their own wealth. So they kind of hire a team to actually manage their wealth. And that becomes like the family office. They still run the restaurant, but, there's like a separate team managing their wealth, if you can believe it. So I worked for a multifamily office that was managing capital and kind of, coming up with investment ideas for high net worth individuals and ultra high net worth individuals and families. I was on the private equity and venture capital team there, got exposure to private equity and venture capital, doubled down on venture capital for 4 to 5 years, helped build a fund for 5 years, which kind of gave me that empathy for not only being an investor, but being kind of a builder of an investment strategy and kind of what that meant and how hard that actually was and how iterative that was and how non-obvious that was. And so I think it was that experience of, helping not only invest, but to build the fund as well that kind of led me to, hey, maybe other people need this help.
Right.
And so, that kind of, is the long story short of the kickoff to Coolwater.
What a cool background. And do you remember what that aha moment was? You're building the fund, you're 4 or 5 years in, and you're like, wait, I can help other people do this.
There were a couple aha moments, but I think it was like I was reading a pitch deck probably at like midnight. I'd be like first in the office, last to leave, like trying to
start a pitch deck.
Trying to do my duty, like a GP's pitch deck, like a VC firm that had come in. And again, like I have had, when I was working at the first multifamily office, like, the best, the greatest in the world, KKR, Carlyle, Blackstone, Warburg Pincus, Bain Capital, like world class, best in class. Like these people come in and you're like, oh, that's what a great pitch looks like.
Yeah.
And then kind of, doubling down on venture, you kind of start to see more emerging managers, right? We were kind of investing earlier stage. And so I remember, this particular pitch where a manager came in, the GP came in, and I was like, wow, that is so polished. I wish I could be that articulate on like day one. And then I was like reviewing it and being like, oh my goodness, like this person, right? Like they've been preparing their whole life for this moment, like they've been building the firm for like 5 years. And I was like, oh, of course it sounds polished.
Yeah. They've been doing it for 5 years.
Because of 5 years. But it was like, there was an inflection point where like they had been doing something, but then they wanted to get to the next level. And it was like, then they came to us, the institutional LP, like the institutional limited partner.
Yeah.
And I was like, wait a minute, like, I think it was like the first fund.
Wow. Okay.
But they had, again, like preparing, like doing like kind of, their proof of concept fund and kind of, building kind of an investment track record. But I just remember thinking like, oh, of course, like they started last month and, they rolled out of bed in the morning, said like, I'm going to be a VC. And it's like, it was so silly to like think that way. Right. But also like you kind of need some of those like aha moments. And so, it's kind of, I remember that particular kind of, reading that pitch deck moment. So that kind of opened up my eyes to maybe there was like a world before the world, right? Like the pre-institutional, institutional help, right? Like what happens to managers before they pitch LPs, like larger check writers, institutional LPs. And that kind of opened up my eyes where, I was at the time meeting 500 funds a year and thinking like I was meeting the whole market, maybe 3 to 500. 500 was like the big
year. A lot, yeah.
Yeah, it's a lot relatively to other VC fund of funds. But then I kind of left and started, engaging with more of like the emerging manager market. And there's thousands and thousands of people and teams, right, aspiring to be investment managers. And there's tens of thousands of angels, right? And so all of a sudden, like there's this bigger world, like there was kind of a world before the world.
I think if you search angel investor on LinkedIn, I think there's hundreds of thousands of people.
Yeah. So if you break it into like just like accredited investors, right? I think like the actual like SEC definition, it's probably low millions.
Yeah.
Right. And then if you get to like qualified clients and QPs, like it starts to winnow down. But like, there's a lot of those folks. But then it's like, okay, who, right? If that's the top of funnel, who kind of gets to, the institutional level, right? And kind of who is that person? Who is that team? How does that process play out?
Yeah, amazing. And so kind of walk us through that story of this aha moment, this midnight pitch deck, and the founding of Coolwater. And when did you write the books and where did that all come in?
Yeah. So again, it was like a kind of multi-year thought process of, wow, there's so many talented people, right? There's so many good investors and they're raising relatively smaller funds, right? Where again, I had the privilege to, invest as a limited partner into some of the largest and most accomplished, private equity firms in the world. And then you start kind of seeing that like, talent is, upstream or however you want to frame it, right? Like there's smaller funds and there's great investors, right? So starting to dig into the data there and saying like, wow, like, the fund multiples right? Like the performance of returning capital to your limited partners. So if your limited partner invests $1 and you're a smaller fund, like you're seeing some of them, return $10 or $20. And you're like, wow, like that's amazing. You even saw a couple of, I guess what people call moonshots and return $200 if you invested $1 from a fund.
Yeah.
Because
I think Chris Dixon's first fund was like 110x or something like that.
Like just really like those are what you expect if you write a direct investment. And so the concept was like, well, maybe right from like a risk adjusted return perspective, maybe if you invest into great investors who kind of acknowledge portfolio management and portfolio construction and again, have the relationships and have the access and kind of like, deliver on kind of the promised strategy, like there's some really attractive returns to be had at potentially lower risk than just doing like a one-off investment into a really early stage company that is more likely to fail than not, right? Just in terms of pure probability. And so from that perspective, it was like, okay, well, is that more institutional than like writing an angel check, right? Like finding a great GP, like a great manager, a great investor, and backing them and helping them, right? Like if an institution were to choose between like writing an angel check into, again, a great team, right? Just a tier 1 team that's doing a direct company, or writing an institutional check into, again, a tier 1 team building a smaller fund, right? What's the better risk adjusted return? Where are you more likely to kind of deliver, not even alpha, but just like beta? Like you're almost like with each fund, you're not buying an index per se, right? You kind of are buying a, multi-asset portfolio, which can potentially lead to, I think better returns, right, over time, or at least more consistent returns than kind of like, shooting from the hip and trying to be the smartest person in the room and kind of choose like a single asset. Again, like even if the team is great, it's just so hard to build a company. You kind of want that kind of risk adjusted bet from the institutional level. So that was kind of my thinking, I think a little bit behind kind of, why would I focus more on funds if there's kind of like carte blanche, I'm not tied to an institution, like you could be a VC or you could be an LP. Like, why would you want to be an LP, right? Like there, again, like if you're focusing on it from like, you want to build an institutional firm, you want to be an institutional investor. I thought, there's this opportunity to, capture more consistent returns by focusing on funds. And then the other piece there was, just what is different, right? Like if you come to market, and again, like if you're in Silicon Valley and you've got growth mindset, and you're talking to people that, are some of the most ambitious, aspirational, creative people in the world, right? In San Francisco and the Bay Area. Like if you're talking to those people kind of day in, day out, right? It's just like, how do I write position? Like, what's my differentiation? All these words people kind of use to kind of say like, okay, right? Like you fundamentally need to kind of solve a problem. But it's like, that's not good enough, right? Like, it's kind of like you need to stand out. And so I thought about that from kind of like a grassroots level, where it was like, if Coolwater were to be, if I was to create my own firm, and kind of build it from the ground up, like what would be different, right? And why would I do it kind of differently, or how would I do it differently? I think the why was I would do it differently if it could be like substantive and valuable to the ecosystem, right? Net additive to the ecosystem. And this was something that was kind of drilled into me actually in grad school, which was like, if you're going to contribute to the academic literature, right, write something that's different, right? Build on stand on the shoulder of giants, like other people that have kind of done research. And, when you write your dissertation, like make it contributing, right? Like net additive to the literature of the world, not just redundant. And so again, the same kind of, philosophies and thought processes of, okay, I'm going to, create my own firm. How do I make something that is valuable, but also different? Concept of, I think other people have described it as Y Combinator for funds, right? Like that's the heuristic. How do you redefine what it means to be a limited partner, right? YC redefined what it meant to be a venture capitalist, right? But no one had redefined what it meant to be a limited partner. And I think that was kind of the concept in which Coolwater was built on. Yeah.
And I'd love to dig into that thread of redefining what it means to be an LP. How was it done maybe back in the day when you were in the industry, but before you launched Coolwater? And what was that vision for how to redefine the LP? And maybe for some heuristic context on the YC model, the way they redefined it was kind of batch processing, cohorts kind of going through together and kind of going through a demo day. Are you running a similar model at Coolwater? Like, what was that innovation there?
If you think about, right, like who's redefined being a, VC. From what I saw, no one was redefining what it meant to be an LP, a limited partner. And as an entrepreneur, like that can be frustrating, right? Like if you're kind of day in, day out, kind of doing the same motions. As an institutional investor, I supported and helped lead 93 investments, right? So
into funds
and co-investments. What is the marginal benefit or kind of innovation or novelty on the 94th investment, right? And are you optimizing, right? If you're just kind of doing the same thing like day in and day out. And I think I wanted to, attempt to create something kind of different there. So breaking it down to the fundamentals, right? Like what does an LP do? Similar, like you could probably do this for a VC, but we're going to do the exercise with like a limited partner. So what does like a limited partner do? They source, right? They due diligence and they invest with the advent of value add. Yeah. But an LP's role is more capital allocator. Like they're not really meant to be value additive, right? Like that's not the expectation. The expectation is I have capital. I'm the principal. You're the GP. I'm going to allocate some capital to you. You're going to, manage that, invest that, and kind of in a, expected period of time, return multiples of that capital. Like that's the dynamic. Yeah. Because we're thinking about a kind of more meta level. Like what is the innovation that kind of Coolwater is bringing to the table? From the sourcing perspective, the traditional way of being an LP broke, right? Because LPs, especially in venture capital, were used to dozens of firms coming to market per year, right? Or they were used to kind of two types of firms coming to market. A traditional VC firm spin out.
Yeah. So some partner GP of the firm leaves, starts up their own fund. They already have a track record. They know what they're doing. They have the LP connections.
Or you sold a company for $1 billion and now you're raising a VC fund. Because of the number of, unicorn outcomes, which is not many if you've done the research on the liquid side, that's not a lot. That's not a big opportunity set, right? And so if you're the person in charge, the LP in charge of covering venture and private equity and other parts of the private market, right? With a relatively smaller private market at the time, again, we're talking kind of 10 to 15 years ago, you can manage that, right? Yeah. This is from a sourcing perspective is what we're talking about. Right. Like you can manage the sourcing of VCs because there's a
limited quantity of them to look at. And
365 days in the year, right? Maybe 250 business days, right? There's 50 kind of opportunity set there, right? So
easy, one a week, couple a week,
right? But what if that changes, right? What if the barriers to entry come down? What if there's more angel investors? What if there's more success in venture capital? There's more people now who can be sophisticated angel investors, right? There's kind of these wins that happen and then they compound like, wow, that person got like a 10x fund. Like they made 50x their money by investing into, 50 assets. Like I want to do that. Right. And then like the venture went from cottage industry to mainstream, and then why shouldn't venture from like a startup perspective went from cottage to mainstream? Like how do you build a startup? Yeah. So it's like, why wouldn't kind of the GP world, like startup of an investment firm, like why wouldn't that go from cottage to mainstream?
Yeah, and what I think you're describing is what happened over the last 20 years in startups generally too, which was kind of upstream of what happened in VC. You had things like the cloud come out, right? AWS, and now instead of $5 million to get your Hello World website up, you could just a couple guys with a laptop in their dorm room could figure it out. And so now you had also platforms like AngelList come out, 10 or 15 years ago, democratizing access to these early stage opportunities. You just had a velocity of startups being created, which means you have to have like an equal velocity of emerging VCs to address these 10,000 startups getting pre-Series A funding every year.
Right. And the game changed, right? And so you had all of a sudden, you didn't have dozens of top of funnel, you had hundreds. And now you literally have thousands of top of funnel.
Yeah.
So again, if you're an LP, you can do a couple things and just say like, hey, I don't care about the long tail. I don't care about those other opportunities. All that matters is like the next spin out from a tier one. And you do see this in the fundraising data. Like most LPs do care about that still. They're like, yeah, let me back that kind of $400 million spin out versus again, like, is there another platform, potentially Coolwater, that can identify these smaller funds that are excellent, right? Excellent investors, but they just happen not to be raising $400 million because the market cap, liquid market cap you need to generate to return kind of 3x, 5x your money on 400 million is very different and much harder based on historical exit markets, even in the US. Right? And so the sourcing kind of changed. So that was one reason, like, reinventing the LP, like, is there a scalable way similar to how like, YC can do it at scale? Like, is there a scalable way to engage with highly talented investors that also happen to be, raising and investing smaller funds, which again, the data points to smaller funds outperforming larger funds. Right. And so again, from an institutional perspective, is there a platform that can identify, source and identify great smaller funds and do it at scale, which is a key point, right? And I think most people, most LPs, it felt like the zeitgeist was to not attempt to like change with the change of the market, which was like more and more funds coming to market. It was just like, decision paralysis,
too many. I'm just going to go to quality. I'll just do the spin outs.
I'm just going to go back to my roots and kind of say like, I don't need to like know, right? And is that the best investment decision? And again, I kind of say it as like, if there's 1,000 opportunities that you see, and if there's 1,000 startup opportunities and you only see 100 and you invest in the top 10% of that 100, have you invested into the top 10% of all opportunities? Right. What's the likelihood of you having done that? And so I think, like if you think about it from, taking a step back, just from a pure probability of talent, right? Like if Harvard, or whatever, Stanford, or, name your favorite institution, it doesn't have to be kind of a brand name college, but what if they only source from, Nebraska, and there's great people coming out of Nebraska, but like if they said, hey, we've got the top 1% of Nebraska, have they gotten the top 1% of all the US? Maybe they've gotten one or two, but like, again, like if you source from a bigger pool, my view as an investor is like you have a higher probability, again, if you see the opportunities to kind of, what's the game of venture? It's investing into the top decile, right? Or top quartile, but really top decile. Like, are you actually investing in the top decile if you only see 100 out of the 1,000 opportunities that come to market every year? So again, like you have to think about it from like the innovation of being able to see more. It's kind of like first principle thinking
and investing, right? When I did my first fund, I was like, oh, I can do an AI fund. I led the AI category, AWS, whatever. But I kind of knew, I put my, financial background, my CFA hat on because I worked, in finance 20 years ago. I was like, well, what's the right way to construct a startup portfolio? Thinking from first principles, you can't get yourself too far into a niche and then you're not seeing the whole universe, right?
Yeah.
You have to broaden your aperture to make really good investment decisions. I think is the lesson there. So is there a platform like Coolwater?
Yeah. So I think the other two innovations, one was on like the just identifying, right? So great that you sourced, great that we figured out kind of a scalable way to source, but now can you actually like partner with the true builders, right? So there's kind of that pattern recognition of, right, especially from an institutional LP's perspective, like they want to bet on things that are going to raise multiple funds, right? It's a lot of work to kind of underwrite. Right. You do it on like a one and done fund, or then you got to go back to the drawing board for a new fund, for a new like series. So really what institutions are looking for is like, like durability, sustainability, duration.
How do you assess that? Like when you're looking at a fund manager, are institutional, like kind of the rule of thumb I've heard in the industry is they don't really look at you until like fund 3 or 4.
Right. Because they don't have the ability. Again, we're talking about the innovation of being a limited partner, like the ability to do diligence. The traditional way is you have the pattern from fund 1 and fund 2. And so at fund 3, you look back at that pattern as the institutional LP and say like, okay, I have data to work with here. Right. The traditional way of investing is let me meet with you like the Revolutionary War, kind of the redcoats marching out, right? Like and being very formal about, okay, we've met each other now like 3 to 5 times over 2 years.
Yeah.
Like you've shared with me your data room. I process your data room. Now I'm ready to make that like decision to invest or not. Like that's a very like formal process.
Right.
It has worked historically, to be fair, but again, it doesn't scale. And so if you're like, hey, it takes you 2 weeks to process a data room, right? Again, we only have 50 weeks in the year ish, right? So now you're down to 25 managers reviewing 25 managers again. There's 1,000 managers. So you're missing 975 reviews, right? If there's 1,000 managers coming to market. So is that an optimized process, or the traditional limited partner way of investing, is that broken? The Coolwater way was co-build with managers, right? And kind of see what they're doing, create a community around it, and kind of see like, who is actually grabbing the reins. And it's amazing. A lot of LPs don't see this, right? And the way I see it is like those LPs don't invest into the people that are doing the real work, right? And so it's almost like capital in today's market is misallocated, because the people that are doing the work, that are actually building, that are actually spending the time, that are actually doing the things that institutional LPs want, those institutional LPs don't see that, right? But then you see like the outcome, which is like this person fundraised, right? Or didn't fundraise, right? And so there's a lot of like people that, are in that almost like under optimized fund size relative to kind of the value they're adding to the ecosystem.
Their ability to deliver alpha or deliver 10x funds is not correlated to their fund size.
Yeah, well put. And then the third innovation I'll just touch on and then wrap up this point was just from like a value add at scale, right? So and this is very hard as someone who makes thousands of value added introductions a year, is very hard to even make like one high quality value added introduction. How do you create value add at scale? And I think the cohort model was a very straightforward way to do that.
Right.
So before I launched Coolwater, I was kind of helping VCs more on like a one-on-one basis. Right. And by having
so it'd be like you'd be a fund advisor, take a little equity in the fund, maybe a little consulting fees, and kind of say, hey, I'm going to help you go do this thing because I believe in you.
Yeah. And so, but what I noticed was like, right, like everyone is capped by their own limitations and their own kind of knowledge set. Right. And I read this book, like, I want to say like 2 decades ago, maybe longer. It's called like Wickonomics.
Oh yeah. I remember that one.
Yeah. Remember that one? Like that was probably like my first kind of exposure to like the value of like crowdsourcing, like information and just like best practices, right? And then I also kind of saw it when I was on ILPA's, the Institutional Limited Partners Association Research and Benchmarking Committee, maybe the nerdiest committee in all of private equity, but it like sets the standards for the private equity industry, which flows down into venture capital. And it was this like crowdsourcing way of, and then what was the outcome? It was kind of informed by dozens of the best, right? And it was more valuable doing it that way, right? So just a couple like formative experiences from my own kind of history. And so the idea of like adding value is like the same way. It's like if you're doing it one-on-one, you're kind of capped by just the knowledge base of your client and your knowledge base. But if you do it as a cohort and there's 20 excellent, well-curated, great people, great teams, like in a cohort, and you manage that the right way, that's a really key point, right? Like you can't just like let it happen. It's not like a laissez-faire strategy. It's a micromanaged strategy. But if you kind of micromanage the dynamics across the teams, you actually get like, shared best practices. You get, in my view, like better outcomes, right? Like you get optimization, especially like, again, it's a top of funnel to curation to like, working.
It's a university model. Like you go get an MBA, they put you in a cohort. They don't, and so you kind of have these 60 guys and gals that you learn from. Yeah, exactly.
Yeah. And so that was it from like a value add perspective, where it was like, okay, am I adding value one-on-one, more value by being like an enabler of the ecosystem or of this cohort model? It felt right. Like, how do you measure the KPIs on that? Like, it did feel like there was more results, more opportunity, more connections doing it with that model. Yeah. So again, it's like, as an LP, kind of think of it as like a one-on-one relationship. I'm a capital allocator. I invest into this firm. I now have this one-on-one relationship. That's a very important relationship. You don't want to lose that kind of personal dynamic. But if you're thinking about it from like, we want to be the number one value added LP, how do you actually kind of manifest that? Like, what is the innovation you need to do? Right. And so again, the cohort, it's not a massive innovation, but sometimes innovation is like taking
it wasn't venture.
Yeah. From one place and kind of bringing it to another place. So take it from VC and bring it to LP world.
Coolwater are kind of a double-sided cohort. So you have a cohort of new managers and a cohort of LPs that are interested in new managers.
You could maybe think about it that way, but it's we don't have a cohort of LPs. We call them like teachers, right? Experts. And so we have over 600 experts that have some vested interest in the emerging manager world or the venture capital world. And so they like tapping into, right, like a curated community of great next generation managers. And so, and again, like they're also of the personality where they want to like give to that community because again, like it grows kind of their presence and their ability to engage and have a relationship and potentially allocate to these managers.
Yeah. So would you describe Coolwater as more of an incubator or is it an accelerator?
It is both. I think the incubator strategy plays out still more one-on-one. So again, like I talk to investors sometimes up to 2 years, maybe even more before they spin out of funds, before they leave their company, before they kind of launch. Right. So there's a lot of that that happens. And fortunately, I can be very efficient with kind of those engagements.
Year and a half from like, hey, I want to do this. Took them 18 months to get that anchor.
Again, like they were investing, via another platform, but like this platform kind of gave them the ability to demonstrate like a great track record. I view that more as an incubator where like you're getting on the call with them, helping them figure out strategy, you're ideating. What does the market need? How are you positioned in the market? Is it going to be sustainable for you over time? Like, is this really what you want to do? What's the organization going to look like? There's a lot of framing and sometimes there's even like building that goes into that, right? Like we have a CFO business that like we can build and run your back office if you want. Like we can get in very early, like help you launch from like the operational perspective as well, not only just the strategic level, but that's the incubator. And I think some people do join what I'd call the accelerator to incubate, right? They're like, maybe it's two partners where they're like, I need to figure out like if I'm going to do this with this person. So are you going to figure it out yourself? You could, right? Sit across from the table with them and just like, read questions and be like, what's your answer? How do you think about that? Right? Or do you really want to like co-build with someone for like 100 hours through an accelerator and see like, how did that experience go? Right? In a very like short amount of time, like 2 to 3 months, co-building for 100 hours with like a potential partner. I would view that more as like an incubator model, almost like an entrepreneur first or something for funds, not for companies where, they haven't formed the fund yet. They may not even have formed the team, but they want to test the team. Like they know they're going to be a VC, but like the accelerator allows them the space to figure out, what is the concept I'm going to bring to market and how is that going to be different? We might save LP dollars if like they realize they don't want to manage other people's money. We've had that outcome, right?
Interesting.
They're just like, right, we've had people writing 6-figure angel checks that are like, I want to be a fund manager. Can I go through your accelerator to kind of, figure out my life? They come through and they're like, actually, there's a lot of additional things I didn't even realize that go into being a fund manager. I think I'm just going to stick with being like, a 6-figure angel check writer and say, like, okay, great. Like, at that level, you could probably retire anyway, but they just can't, right?
Keep doing stuff. Yeah.
They have to keep doing stuff. If they take the money and then like their heart's not in it, right? Or their mind's not in it, then that might be potentially detrimental to like LP capital, right?
Yeah.
So again, that's more like the incubator side. On the accelerator side, we work with funds like 1 through 4, right? And I think most people come in probably thinking kind of 3 things. One is, right, like fundraising is existential, right? Am I joining a community that can help me kind of supercharge my network? I think the other thing is I need to be around like-minded people, right? It's the same reason why you probably go and get like an MBA. Now those are doctors and dentists and like, philanthropists. And I don't really have any business people like around me, right? So it's the same reason, like I need fund managers, fund builders around me, right? So you kind of elect into that. And then thirdly, again, if you're high quality, people that are good hopefully want to be great, right? People that are great hopefully want to be better, right? And is it like, what are the best practices in today's market? Like, what are the best practices overall? Like, am I doing them? Have I implemented them at my firm? That can be from a fundraising perspective. That can be from a financial, operational perspective. That can be from like an organizational kind of, team building best practices perspective. So all those things, it's like, are you joining the right community that, again, is biased towards being institutional, which Coolwater is? The Accelerator works because like you can get really talented people that are very excited about building. And they're like, right, like great people want to hang out with great people.
Right.
Like you get them to kind of buy into the cohort model as well. I'm buying in, everyone around the table is great, right? And we're kind of working in tandem, right? Like you get kind of the 1 + 1 = 3 dynamic over and over and over again. That kind of compounds. And then you get an advantage, right? It isn't necessarily if you're running a 1,600 meter race or even a marathon, like it doesn't happen off the start. I'm running a marathon, like, look at me, I'm winning after, 100 meters. That's not how it plays out, right? It's like, but fast forward, 24 miles in the race, you're like, who's winning, right? It's the field has kind of broken off. And so it's like, what is giving you that compounded advantage over time? Yeah. Which community, which network, which training program? And that's how I think about the accelerator.
I love that. Like, how do you look at all these other accelerators, incubators for venture coming out, and how do you differentiate, and how do you view them?
We pioneered the model. I don't know if we need to differentiate. We just need to perform, right? And that's true for anything, right? There's more than one car brand. There's more than one kind of restaurant choice, right? There's more than one shirt brand. There's more than one book. Like the fundamental kind of human reality is like, there's going to be redundancy, right? And choice. Time is everyone's most precious asset. Like where is the community where you will outperform, right? And again, what's the benchmark for outperformance? And like, are you going to a community that prides itself on volume, or are you going to a community that prides itself on like quality? And then the second piece is, why would you work with one organization versus another? Who is the type of kind of person that is around the table, right? And is it like the person that is around the table, are they kind of a corporate employee? Or are you like building a firm and a fund that's going to be legacy and institutional and long-standing, right? Like what are your goals? And I think who I'm trying to partner with is not everyone. I'm trying to partner with people that align with kind of this worldview that I believe I'm the best. I believe I'm a great investor. I believe I can build like a world-class institutional firm. Who is the team? Who is the platform? Who is the organization? Hopefully Coolwater, that like is your partner in that journey. That's the goal, right? And you have to kind of understand what's around the table. But I think more people pay attention to kind of what we're doing because we pioneered the concept, and like we're usually kind of pioneering kind of the innovation still. And then we have the copycats. If that's the positioning, right? Because we're building funds and focused on the fund manager, they are helping kind of teach people the business of VC. It's a very different, right? Their philosophy is similar, right? Like they like similar to me, like I want innovation to thrive. And I think it's probably the fastest way to solving a lot of kind of humanity's greatest problems.
Right.
So we align kind of philosophically, but again, our go-to-market, so to speak, is like very different. And kind of the community in which we have, right, of like builders versus venture capitalists, right? Like you can be a VC and not be a builder, right? And so we do view ourselves as like a community of founders of investment firms. Like those people have to make tough decisions every day, every week, every month, every year for decades, right? They're the people that like we're focused on and trying to partner with and trying to help. Because if we're successful helping more decision makers get into business, right? Not just people learn about venture capital, right? There's a difference between education and implementation. If we're helping people get into business, understand it better, implement it better, grow faster, right? And be higher quality. They're already high quality, be higher quality. That I think is an advantage, right? And that's who I'm looking for.
I love that. I could talk to you for another 2 hours about this stuff. And I know you have a hard stop. So where can emerging managers who are high quality get in touch with you?
Yeah, reach out on LinkedIn is probably the easiest way. Mention that, you heard us on this pod, and I'll definitely respond.
Thank you so much for coming on. We'll have to have you back at some point in the future.
Cool. Thanks, Brian.
Thanks, Winter.